So today we're going to learn about Japanese candlesticks patterns as well as reading them on our charts because they are, no matter which way you're going to trade, no matter what you're going to invest in, you need to be able to understand a financial chart to see what price is telling you. Now, candlesticks are a form of charting developed by the Japanese rice traders all the way back in the 17th century. And it's been brought forward. Now, candlesticks have been around for a very, very long time. Now, as you see, they weren't developed for the financial markets. And when I started trading 40 years ago, we were trading by hand. We were charting by hand. And very few of us used candlesticks because they were time consuming to put on a chart. And we were drawing everything by hand on our charts. But as time went on and we built this huge volume of retail traders and retail investors, or self-traders or self-investors. Remember in my day, my father's day, my grandfather's day, when they wanted to buy shares of stock, they would call their broker and say, I'm interested in some technology shares. I'm interested in some banking shares. Or I heard something good about GE Capital. They would never look at charts. It was their broker's job to do the analysis and just say, yeah, I think that's a good deal. Maybe we can buy them, put them away, or it's going to pay a dividend, whatever. But that was it. Today, most stocks, bonds, ETFs, and even our retirement funds are self-managed. So we have to be able to use some of the tools that are out there. And with the growth of the internet and the advancement of HTML and Java charts, now we can do everything and anything that these big brokers were able to do in their offices. So candlestick charting is a complex charting method of putting it actually on the charts. There are wicks and there's bodies and there's colors. And then even interpreting them is quite time consuming, or was. You'd have to memorize all the candlestick patterns. You'd have to memorize how to read the but all of that's been simplified for us by the use of a computer. Now, if you don't understand what a candlestick is, let me pop you over and real quickly share this with you. I'm going to pop up some charts on your screen. Okay, so here we're looking at my standard teaching chart. And what you see on here are these red and green things. These are candlesticks. Now we have many different types of charting. We have bar charts. We also have line charts, area charts. But candlesticks have become one of the most popular charting methods because they give us a lot of information in a very easy visual format. Now, as I mentioned, it used to have to do what we call candlestick recognition, because candlesticks are not about all the red and green you see. They're about reading the size of the candle, its wicks, and its position, and what the previous candle and what the next candle are trying to tell you. So the body of the candle is this. And as you can see, these bodies are all different shapes and sizes. Well, that is the difference in that time frame of the open to the close. But the width or the size of that body of the candle tells you something, especially in comparison to the body of the previous candle. The lines above and below are known as wicks. These are the high and the low of that time period. And sometimes, as you can see, we have little bodies with little wicks. We have big bodies with little wicks. We can have little bodies with wicks, very long wicks in one direction and nothing in another direction. There's all types of things, and these all tell us something about price. Now, remember, when you're looking at a chart, it's all about time frames. Now, today, we're not here to learn about time frames. But for instance, we're looking at a 1 hour chart. A 1 hour chart would have no value to you as an investor. It would help you as a trader. But we can simply change that to a 1-day chart, because now we're looking back over the movement of that asset, in this case, the euro US dollar, from all the way back in mid-December forward. So if you were looking to invest, you'd want to see how that asset has been trading in the long term. If you're looking for a very, very long term or historical, you might want to go back and look at it on a 1-month chart. Now, of course, all my lines are on here for support and resistance, so they get, because I'm not looking at it for investing. But let's see if we can get something cleaner for you. Okay, so if you were looking to buy Wells Fargo and invest in it for a long period of time, you're looking to put it in your retirement portfolio. Okay, you'd want to see that. Well, look at that. Wells Fargo was trading all the way down here at about 1672 in 1999. It moved straight all the way up here, and through September of 02, then we know it crashed, because we know what happened is we had the financial crisis, and then it's recovered higher than what it was back in the peak of its time. So right now, Wells Fargo peaked at $66 in January of 18. Now it's fallen steadily down. So if I were looking to buy Wells Fargo for a long-term investment, I might say, well, it's down at 21.72, and it's a good buy because it's most likely at some point going to recover back up to maybe not the $66 range, but to its average range. Now, when we go back and look at it in a smaller period of chart, we see the same range, but we see a smaller, more concise area. So again, the time frame on your chart is really dependent on what type of market or what you want to do, whether you're looking at investing, trading, putting away for retirement. If you're looking at, dividends, like I used to only, when I was younger, I used to buy high risk stocks because I wanted the reward. I wanted them to go up. When I got older and started to retire, I moved everything out of value investing and over to investing only in dividend stocks. Well, I got killed in 2008 because all those stocks stopped paying dividends. GE Capital, Bank of America killed all their dividends, and their stock crashed. So when both things happened, so. But if I was looking in a short-term investment for Wells Fargo, look at that. I would see that it's climbed all the way up to here. It's peaked out here. It's come back down. Now, would I want to buy near the top for a long, a medium-term investment? Maybe not. Okay, but maybe if I see it fall down here to the 29.27 level, I might consider buying. But that's reading a financial chart. Now, candlesticks help us read charts because we not only see the body of the candle. So that tells us, because what's very important is where price is trading in comparison to its open and close for the day. But also what's very, very important is where is price in relationship to its highest point and its lowest point. So those are the wicks. But as I mentioned, candlesticks are also about the relationship to the previous candles. Now, back in my day, we had to memorize at least the 36 primary patterns of candlesticks. Today, we don't have to do that. See where it says BE down here? That stands for bullish engulfing, because it's one of the candlestick patterns I look for. So I've told my computer just whenever a bullish engulfing pattern appears to notify me. So a bullish engulfing pattern is when the most recent candle was bigger than the previous candle's entire body. Now, because of, like I said, because of our wonderful computers, I can tell my system to exactly what I would like it to see. So in other words, these are all the different candlestick patterns listed on the right here. If I wanted to notify me or put it on my chart, like I see I have bullish engulfing and bearish. I don't use most of these other things, but 3 methods, 3 falling windows. Okay. Hang a minute. You can tell your computer. So today, using candles has become a lot more popular because you don't have to spend hours watching for patterns to happen. They just pop up. When they occur, your chart tells you. So here we have tweezers top. Tweezers top is when you have the 2 highs equal distance. Okay, and the candles are opposite color. That's telling you that move up is over and you're going to go into an opposite direction move. Okay. But candlesticks can be very helpful in understanding and predicting the financial markets. So let's go back to my PowerPoint. So as I said, what makes up a candle? It's the open, the high, the low, and the close. Now, what's the difference between a red and a green candle? Now, first let me explain the colors. Red and green are not the original colors for candles. They were black and white. Because back in the old days, we didn't have colored pencils, colored pens, color magic markers. We shouldn't have computers. So if you were charting by hand, you used a pencil. And if it was a bearish time frame, in other words, you step down from the open to the close, you'd use the side of your pencil and fill it in. If it was a bullish time period, in other words, you step price moved up from the open to the close of that time period, you would leave it hollow. So in other words, you would see a black candle or a hollow candle or what we call a white candle on your handwritten charts. That got replaced with computers, and red and green in financial industry, and just like everything else, like stoplights, red is negative and green is positive. But the fact is, you can use pink and chartreuse. You can use purple and yellow. As long as you know which one is representing bearish and which one is representing bullish. In fact, a lot of brands, trading brands and brokers, automatically put their candles on the charts based on their corporate colors. It's unimportant as long as you know which one is relating to bullish and bearish. So bearish means the price declined from the open to the close. Bullish means that the price climbed from the open to the close. Let's go back to my So here, if we just go over to my chart settings, see here in the body of the candle, the borders and the wicks. Okay. They're colored red and green. But if I decided I wanted to use royal blue and gold, I could. As long as I knew that the gold was negative or bearish and the green, the blue was bullish. Let's put it back to where it was so I don't forget. Okay. But it's completely up to you to set them to whatever you're comfortable with and whatever you know. So like I said, if your football league's colors are orange and pink, well, that sounds red and green or red and blue, you can do that. It's up to you. It's unimportant in the scope of reading your charts. Now, compared to traditional bar charts, many traders consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides an easy to decipher picture of price action. Immediately, a trader can compare the relationship between the open and the close, as well as the high and the low. The relationship between the open and close is considered vital information and forms the essence for candlesticks. So we talked about the shape and the size, being the open and the close and the length of the wicks. But if you think about the markets being a battle between the bulls and the bears, the buyers and the sellers, The difference between the open and the close tells you who's in control. If a candle is white or today green, it's telling you the bulls or the buyers are winning the battle in that time frame. If it's the opposite, it tells you the bears. So if you think of this as a tug of war, do you ever go play tug of war over the waters when you're out camping or summer trips, whatever else? There's one team of 5 guys on one side and the 5 girls that you're out with the other side, and you're pulling your rope across the little stream. And whoever pulls on farther, the girls fall in or the guys fall in, and everybody's having a good old time. So if you think of that part where the guys are standing and the end of the rope is the wick, and the other side where the girl's standing is the end of the rope and the wick, and the center, that's the body of the candle, the difference between the girls, the 2 sides. Now, the girls yank really hard. The boys fall into the water. They lose their grip, and the girls fall to the back. What happens is they're winning that battle. Well, that's what you can see in this battle. You can tell who's in charge of price at the moment, which is a vital piece of information. It helps you make solid market decisions. It helps you understand what is happening. Now, don't get yourself lost in a psychological response to groups of reds and greens. These do not say take a position. They're just what's happening in the intermediary. And if you see 3 green candles or 3 red candles, it doesn't mean price is collapsing. It means the girls pulled harder, and then the girls got all excited and pulled harder again. Okay, doesn't mean what happens is the 2 guys in the back of the rope on the other side are up there chatting up some other girls, paying no attention or popping another beer, and they didn't realize the girls were pulling back, and then they grab on the rope and they just yank hard, and the girls are pulled back into the water. So it's a short shift, but it doesn't tell you the market has changed. Now, long candlesticks, whether they're red or they're white or green or they're black, tell you that's been a very strong move. The shorter the body of the candlestick, the less conviction is in the market. In fact, what we call a doji has a very little insignificant body because the open and the close are almost the same. And that's telling you the markets are undecided. Nobody's winning the battle. Nobody's making any primary decisions. But so we can interpret that by a little bit of the shadow or the wick. So when we saw the girls pulling the guys in the water, and then the guys finally put their beers down and yanked back really hard, we got a long wick on the other side. Then it balanced itself out. Tells you something. And then there's certain patterns that we see in candlesticks. Okay, that a candlestick exhibits. One of them is called a marabuzu. Marabuzu is in the background here. It can be red or green. One's bullish, one's bearish. But can you tell me what you don't see on the marabuzu? There's no wick. It means at the beginning of that session, whether it's a 1-hour session, a 1-day session, whether it's a 15-minute time frame or a 1-month time frame, that if it was green or white, that the bulls started pulling from the minute of the open, and they kept pulling all the way to the close and winning. The bears or the other side never got any footing in. And the bulls, or say in this case the boys, were still pulling it and in complete control at the end of that time segment. When the whistle blew, everybody let go, the boys had control. Doesn't mean it's going to stay that way, but you would assume when it starts the next time period, because it starts instantly, that the boys will keep in control. Now, the girls might have battled back, got themselves all hepped up, and pulled back the other way. But in that time frame, you saw the boys were very much, or the bulls were very much in control. And there's a good chance it will continue at least in the beginning of the next time frame. When it appears in a trend, okay, it can signal that an opposite directional move is about to take place. Then we have things called spinning tops, okay, where we have equal distance wicks and bodies. And then I mentioned dojis. But we always have to be looking at where price is and what the trend of price is as to where these appear in the movement. It's not as easy as just following 5 steps that I give you, and you mastered the world. So we're always looking at the candlestick formation in contrast to the overall move, as well as its position between the previous and the upcoming candle. And there's all kinds of weird ones out there. Okay? A lot of these don't tell us much of anything. They give us some indications. But like I said, today, because of our to memorize these and look for these on your charts and pay attention to them, is very time consuming and awkward. But today, because of our incredible computerized charts, if I want to look for all of these weird things like the dragonfly doji and the Hammurabi cross and the inverted hammer, I just tell the computer to look for them itself, because computers can do it as well as I can, and it's going to put it right on my chart as it appears. Now, as we move forward, we have nothing happening at the moment. So having something appear back here doesn't help us at all. But when it flips up as something new on your chart, then you can look at it, because you don't have to memorize these. You don't have to watch for them. Just tell the computer to do it all for you. So now you have the candlesticks on your chart telling you a story. You have the candlestick patterns telling you a story. You're getting lots of information from this easy charting method. Now, before turning to multiple candlestick patterns, there's a few general guidelines to cover. Now, there are many common patterns that are quite likely to appear before you in any normal trading session, in any normal investment period. They happen continuously. So knowing instantly what they mean and taking the proper action is important. That's why today you don't have to worry about looking for them. When they pop up on your chart, you know what to do. So we mentioned we have things like the star position. That's when a candlestick appears above or below that. It looks like a falling star or a rising star above the previous candlestick price. That's usually only happens in futures, because that's a gap in price. Then we have shooting stars and inverted hammers. They look just like they are. Don't memorize them. They don't help you. Okay? Because there's way too much stuff in today's fast-moving pace markets. But again, if you want to let your computer do the talking for you, it's not making any trading decisions. It's just telling you when these happen. A harami. It's one of my favorite candlestick patterns. He's the newest candlestick is fully engulfed in the body of the previous candle, just like a pregnant woman. The baby is fully engulfed within her, not her head and not her feet, but within her body. And it should be the opposite color. But when you get this, it's telling you something very much about the markets. So there's a lot to remember, a lot to memorize. But what we've talked about is building a candlestick chart, understanding and reading the candlestick, explanation of the shapes and sizes, the formation of the candle, the position of the candle, what a doji, a harami is, what the tops and the shadows of the wicks are, bulls versus the bears. We've talked about hammers and hanging men. But remember, I told you it was a lot more than just reds and greens on a chart. So we talk about generally the Marabuza, the spinning top, the doji. I mentioned to you bullish engulfing and bearish engulfing. And then there's more complicated ones like 3 white soldiers, 3 red, 3 black crows. These are multiple candlestick patterns, but there are 16 primary patterns that you should understand and be able to interpret when they appear on your charts. Now, again, today's modern chart, you just put your little mouse on it, and it gives you the full explanation and tells you what it is, how it's happening, what the explanation is. So then you just have to make some decisions on your own. But regardless of how or what you're going to use candlesticks for, they will provide you a wealth of knowledge, whether you're trading, whether you're investing, or whether you're just gathering some information about the financial markets, whether you're looking at the S&P 500, or whether you're just looking at Amazon, whether you're looking at the euro, or whether you're trying to buy Bitcoin. Understanding how to read a chart, look at a chart, will help you. But the longer the term is that you're looking to participate in the markets, the less relevant the overall chart is. Because you're looking for a retirement benefit. Well, yes, you want to see the historic value where this asset, where the stock normally trade from where it was last week. Like if you look at a gold chart, you see the gold just 15 years ago was about $300. It's now 1,700. Now it's been bouncing between 16 to 17, down to 16, back to 15, up to 17. But if years and years and years ago you bought it at $300, you don't care because you're not looking at buying and selling it. You're not looking at trading. You're looking at an asset with a long-term investment. So that's it today, folks. So I hope you got some understanding of reading, using, and interpreting candles for whatever type of moves you're making in the financial markets. And if you want to learn more, just visit justlearn.academy. Thank you very much.